Hello, this is an AI video made by NotebookLM and is inspired by this video. Now enjoy the video.
Have you ever felt like the whole world of stocks is some kind of secret club? With its own confusing language that nobody ever explains? Well, you are not alone. And in the next few minutes, we're going to crack the code on all of it.
You hear it all the time on the news, right? Sensex is up, Nifty is down. It sounds super important, but what does it actually mean? How does that affect a business, the economy, or, well, you? Let's figure it out.
Now, to understand this pretty complex world, we're going to use a simple and delicious example. So forget all the complicated charts for a minute and just picture a wildly successful panipuri stall. This little business is going to be our guide through everything from funding to IPOs.
Okay, so imagine a little panipuri corner in Delhi. They've got this secret recipe, right? And it's an absolute sensation. Every single day, there's a huge line, and they sell out in just an hour. The owner's got a fantastic product, profits are good, but you just know there's potential for so much more.
So the owner starts thinking, hey, what if I open a proper shop? Get more seating, serve way more people. But to do that, you need money. You need capital for the shop, for supplies. And if you don't have the cash yourself, the most natural first step is to ask the people closest to you, friends and family. You borrow, you grow the business, and you pay them back. Simple enough.
So the shop is booming, and now the owner is dreaming even bigger, expanding across the entire city. But that takes a lot more money than your friends and family can probably give you. You need a much bigger source of funding to take that next huge step.
And this slide kind of lays out that whole journey. You start small with your inner circle, but as your ambitions get bigger, you have to climb this ladder. First to angel investors, then to venture capitalists, and finally, for the biggest leap of all, you turn to the public. So what's the difference between these two? Well, think of it like this. An angel investor is usually just one wealthy person who believes in your idea. They give you money, but not as a loan. They want a piece of your company, a share of the ownership. A venture capitalist, or a VC, is a whole firm that does the same thing, but on a much, much bigger scale. They're the ones who fund those massive growth plans, like taking our panipuri brand nationwide.
And wouldn't you know it, our little panipuri stall is now a national chain. The dream now is to go international, branches all over the world. This requires a colossal amount of money, way more than even a VC can provide. So the company decides to go to the ultimate funding source, thousands and thousands of regular people. The public. And this is done through something called an IPO, which stands for Initial Public Offering. It's exactly what it sounds like. It is the very first time the company offers up pieces of its ownership, what we call shares, to absolutely anyone who wants to buy them. This is the big moment when a private company becomes a public limited company.
But you can't just wake up one day and start selling shares. Oh no, it is a super regulated process. You have to hire investment bankers, and your entire company plan gets scrutinized and has to be approved by the market regulator, SEBI. That's the Securities and Exchange Board of India. Only after they give the green light can you apply to be listed on a stock exchange and finally set a price for each share.
And the amount of money you can raise, it's staggering. Just look at Paytm. Through their IPO, they raised 18,300 crore rupees from the public. That is the kind of massive cash injection that can fund a global expansion for our panipuri empire. But, and this is a huge but, it is a high-stakes game. If you offer up all these shares and the public just isn't interested, specifically if less than 90% of the shares get bought, the IPO fails. You lose the 6 to 7 crores you spent on fees and marketing, and your company's reputation takes a massive hit.
But let's say our panipuri IPO is a smashing success. The company has its money, it's busy expanding, but what happens to all those shares? Well, now they live and breathe on the stock exchange, which is basically a marketplace where they can be bought and sold by anyone, anytime the market is open.
And this marketplace has evolved like crazy. Way back in 1875, with the Bombay Stock Exchange, traders would physically get together and shout orders at each other. Then, in 1992, the National Stock Exchange came along and brought in the computer age. And today, it's all right here in the palm of your hand. You can literally buy a piece of a company with a single click.
Okay, so this brings up a really common question. The company already got its money from the IPO, right? So why do the founders and the CEO get all nervous when the share price drops on some random Tuesday? Why does it even matter to them anymore? While the impact is indirect, but it is incredibly powerful. First off, that share price is basically a public report card on your company's reputation. Second, if you ever want to raise more money in the future, a low price really hurts your starting point. And third, companies often use their shares as collateral to get bank loans. If the value of that collateral plummets, the bank gets very nervous and might put the company in a really tight spot.
So, we've got thousands of public companies, all with share prices changing every single second. How in the world do we get a sense of the overall picture? How do we know if the market as a whole is having a good day or a bad one?
The solution is actually pretty clever. Think about it this way. Trying to track every single company is like trying to watch every TV channel at the same time to figure out what show is the most popular. It's impossible, right? So what do TV ratings agencies do? They take a sample. And that is exactly what the Sensex and the Nifty are. They're called market indices. The Sensex tracks the performance of the top 30 biggest companies on the Bombay Stock Exchange, and the Nifty tracks the top 50 on the National Stock Exchange. They're just samples that give us a pretty good guess about the mood and the direction of the entire market. So who's actually deciding this mood? It really comes down to three main groups. First, you've got retail investors. That's people like you and me. Then you have the institutional investors. These are the big players, like mutual funds, buying in massive quantities. And finally, you have advisors and rating agencies, whose research and predictions can sway the entire market. So after all this, what's the real takeaway? It's that the stock market isn't a lottery. It's about investing in real businesses. Think about it. You wouldn't invest your money in our panipuri stall just based on some random rumor, would you? No. You'd look at their sales, their reputation, their plan for the future. It's the exact same principle here. You got to avoid those hot tips and base your decisions on solid, credible research. So you see, from a simple pani-puri stall to a global brand, the stock market is really the engine that lets great ideas become empires. And it does that by letting everyone, even you, participate in their growth, one share at a time. It really makes you wonder, doesn't it? What's the next great idea that's going to make that journey?